Do you think that sentiment has gotten overdone, that the market is oversold, that it's just throwing a tantrum about the Fed, or do you think there's a real economic slowdown materializing?
Well, first of all, I was pretty shocked when I saw the statement at 2 o'clock. I said, oh boy. I shook my head and said, this isn't good. They barely acknowledged any slowdown. I mean, the wording was just so cautiously more dovish. Don't forget, I mean, we talk about the fact that they lowered by, from 3 to 2 the number of projected funds increases next year. But the market, in the futures market, they lowered it from 3 to 1, barely 1. So, I mean, they're behind the curve. They're behind what the fears of
what
the market
fears
are.
of the market are, Professor. But is there a slowdown? Is there an economic slowdown? We got the jobless claims number this morning. It was at 215,000. It was very low.
Well, this is the reason. And this is the reason. The Fed is mandated to look at U.S. data. And believe it or not, U.S. data looks quite good. You're absolutely right. Jobless claims the last 2 months have been down. I was worried a month ago. They're down. Retail sales in November were quite good. Housing starts, surprise on the upside. That's what they look at. They're not going to take any cognizance of the global economic situation unless they see that directly influencing
but Professor,
the U.S.
Should they be taking a look at those economic indicators? Should they be looking at what the markets seem to be broadcasting? We spoke with Ed Lazier earlier this morning, and he said absolutely the Fed should take a look at the market's message more and incorporate that into their thinking.
I think they absolutely should have. I mean, I am shocked. The 10-year down at 275. I mean, barely positive slope now on the yield curve. I was very surprised on the dot plot. Only 2 members thought it should not have a December hike, and they were not the voting members. I mean, we actually know who they are. James Bullard and Neil Kashkari, they've been outspoken on this, and no one joined them. No one joined them and said, let's take a look at this curve. We can pause at this time. So they are behind. However, they're capable of catching up. I mean, I remember 2000 to 2001, their December, the market thought they should lower it. They didn't. The economy went south. And then in January, they did a double decline before the meeting. They said, yeah, you're right, guys. We really underestimated how poor this economy is. And then they caught up or tried to catch up. So it isn't hopeless, but it was really disappointing in terms of their acknowledgement of what the market was saying. And I'm not surprised at the response.
Given the disparate views between the Fed and what the U.S. markets are telling us, Professor Siegel, should then investors be lulled into thinking that valuations look historically fine, or should there be an embedded discount in the valuations that we're seeing right now because of the outlook?
Well, right now, we're trading at 15 times earnings. The S&P 500, 15 times operating earnings for this year. Even if we have no increase, it's 15 times earnings of next year. Now, the 65-year average is 17. It's actually a little over 17. So we are actually selling at a discount of around 15% from the long-run average, and also in a very low interest rate environment. I think long-term investors are definitely going to be rewarded. However, remember, if there is a recession, earnings are going to drop 20%. You're no longer at 15. You're at 18. You're worried about that. There's political concerns going forward, clearly, in the second half of this Trump administration. There's worries about what's going to happen in 2020. Is there a potential of corporate tax cuts being drawn back? Don't forget, when psychology shifts, and we've had that, everyone looks at, oh, my God, what could happen? The gloomy side. 3 months ago, it was all rose-colored glasses. Everything was booming. Everything was fine.
I wonder
this is what typifies the markets.
Let me just ask you this.
Yes.
Is it possible that is this definitely a slowdown scare, or is it a speed-up scare? Because here's my point. If there's no, recession, if there's no crash at this point, is the market down? Are people concerned about earnings because the labor market is strong? Are corporate profits maybe under pressure next year because of that? But, if the Fed's not hiking because there's no inflation and the economy is still humming along, that's fine. So earnings can fall for a couple of different reasons. They can fall because the top line drops. They can fall because the bottom line rises. Is there a different
Yes.
way to think about what this market's telling us?
Well, one has to remember that 45% of the profits of the S&P 500 come from foreign sales.
True.
So obviously the stock market is going to be much more worried about the foreign slowdown, which we see everywhere, than does Jay Powell, who's looking at the U.S. market economy and says, oh, my indicators say okay. So there's automatically always going to be a disconnect. It's going to be much more the world economy for the stock market, but much more the U.S. economy for Jay Powell and the Fed. And that's one of the disconnects and the reasons we got his ruling and his interpretation. Oh, U.S. data looks pretty good. My feeling is GDP is what's going to be 2.5 this quarter. That's not terrible. It is down certainly from the average of the first 3 quarters. And next year, we're looking at 2. Some are looking at 1. This is a disappointing slowdown. We're not ratcheting up to that higher level that so many people had hoped for in the Trump administration.
All right.
And I think that those fears are weighing on the stock market.
All right.